Exchange at 25 Broad, sponsor of this webcast, invites you to visit our remastered model residences.
Good day, I'm Jen Benpe, and this is The Real Deal. At the top of the news, the Federal Reserve cuts its key interest rate. New York foreclosures are up 30%, and the Paramount Group is selling one of its buildings for close to $1 billion. Also this week, we will hear Ryan Slack report on mortgage defaults in New York City. That and more on The Real Deal webcast this week. The Federal Reserve has cut its key interest rate by 0.5% to 4.75. The cut could lead to further loosening of credit, which could help borrowers whose mortgages are about to adjust to higher rates. However, most experts agree that the average yield for one-year Treasury bills is a more reliable index for predicting changes in ARMs. New York City's foreclosures were up 30% last month, according to research firm Realty Track. Brooklyn took the biggest hit with 1,032 foreclosures in August, up from 822 in August 2006. Manhattan had 79 foreclosures this August, compared to 62 a year ago. Paramount Group is reportedly selling 1177 6th Avenue for at least $1 billion, with Eastdil Secured as the broker. In 2002, Paramount bought the building for $409 million. It sold 32 Islip for $750 million 2 months ago and purchased 60 Wall Street for $1.18 billion in May through a sale leaseback. The city hasn't seen a billion-dollar sale in 4 months. A 3-day deal of the century nationwide discount promotion by New Jersey-based Hovnanian Enterprises brought in more than 2,100 gross sales. Buyers were able to save up to almost $150,000 in New York and New Jersey, with some apartments discounted by as much as 20%. The company had previously reported 4 straight quarterly losses. Fannie Mae and Freddie Mac have gotten permission from the Federal Office of Housing Enterprise and Oversight to expand their loan portfolios by 2% a year. The nation's 2 biggest mortgage buyers will have the ability to purchase up to $20 billion each in subprime loans. Congress and the Bush administration are debating whether to allow the mortgage buyers to purchase loans over the $417,000 limit. And now to Ryan Slack and the Shark Report. Ryan?
Thanks, Jen. I'm Ryan Slack, and this is the Shark Report, a joint venture of The Real Deal and PropertyShark.com. We've heard the stories about mortgage defaults lately, but just exactly how have these defaults affected the New York City market? While the number of mortgage defaults is increasing here, they are by no means doubling or tripling, as reported in other markets around the country. Let's talk numbers. Mortgage defaults for New York City were up 47% in the third quarter of 2007, compared to the third quarter of 2006, the highest rate since data was first collected in 1985. The majority of these defaults are in Brooklyn and Queens, which combined increased their share of defaults from 70 to 74%. Manhattan's share of defaults dropped significantly, from 6 to 3%, while the Bronx and Staten Island held steady at 13 and 9%, respectively. Though default rates have not gone through the roof, the average dollar amount of defaulted mortgages relative to their value has increased rapidly in all boroughs except the Bronx. Average defaulted loan amounts range from $170 per square foot in the Bronx to $396 in Manhattan. Examining the numbers in detail, we found in many cases lien amounts are equal to or greater than property values, indicating that distressed owners are more likely to allow their property to enter foreclosure than to sell their property on the open market. Either way, it is clear that the number of distressed property owners has increased significantly, putting downward pressure on sale prices. While Brooklyn lien amounts increased by only 21% in the past year, that borough saw a double-digit decrease in price per square foot for residential properties during the same period. All indications are that smart money has moved on from Brooklyn and is now investing in the Bronx, where sale prices are increasing faster than defaulted lien values. I'm Ryan Slack, and thank you for tuning in to the Shark Report. Jen?
Thanks, Ryan. 2 different reports were put out this week predicting the effect of the credit crunch on Manhattan's office market. The first, by brokerage firm Cushman & Wakefield, said the financial services industry could see job cuts. But the report forecasts only a slight adjustment in the office market. They said only a pronounced and prolonged downturn in the financial market, combined with drastic job cuts, would cause a downturn in the city's office space, and cited the lack of space and little new construction as reasons. The second report by Wachovia Securities focuses on foreign investors who are offsetting the credit market's effect on Manhattan office space. Italy's Risanamento recently paid over $1,400 per square foot for an office condo at 660 Madison Avenue, the second highest recorded price for an office building. Somerset Partners' expected purchase of 450 Park Avenue has also boosted confidence in the office market. Nevertheless, the report predicted that office sales prices could drop from 5 to 10%, with sales falling by as much as 60%. Sheldon Solo's proposed East River development was scrutinized at a community board hearing Thursday. The proposed complex is comprised of 6 slender mixed-use towers totaling more than 5 million square feet and upwards of 6,100 units. In what may be this fall's most high-profile development battle, some residents and elected officials have already begun criticizing the building's heights as well as their density and parking. 4 of the buildings just south of the United Nations would be more than 600 feet tall. As Donald Trump welcomed the media to a red carpet press conference to promote the planned Trump Soho, protesters outside claimed that the 46-story hotel condo would break zoning rules. Sales began Wednesday and start at $3,000 per square foot. Trump said 3,200 applications have been received for the 400 units. America Online has announced that it will relocate its corporate headquarters to 770 Broadway from Dulles, Virginia. It will lease 152,000 square feet at the Greenwich Village building, which is owned by Vornado Realty Trust. AOL's advertising and programming operations are already based in New York. Tenants at 770 Broadway include J.Crew, Viacom International, and publisher V&U. Developer Thor Equities and businesses along the Coney Island Boardwalk have reached a deal to allow them to remain open for another summer. A deal with a theme park, Astroland, is also reportedly close. 8 businesses, including Ruby's Bar and Grill and Shoot the Freak, were ready to close as Thor planned a $1.5 billion Las Vegas-style resort. Thank you for joining us for this edition of The Real Deal's webcast. Please join us every week for the latest in real estate news. I'm Jen Benepe, and this is The Real Deal.